The Bank of Canada has held its trend-setting rate steady at 2.25%. But with the conflict in the Middle East continuing to push oil prices higher, what are we going to get from the Bank of Canada this year? Could it be a hike? Could it be a cut? Joining us now to discuss is Andrew Kelvin, Head of Canadian and Global Rate Strategy with TD Securities. Great to have you back on the program, Andrew.
Always a pleasure to be here.
I don't know, has the Bank of Canada not been between a rock and a hard place over the past 6 years in terms of what do you do with perhaps the threat of higher inflation and a weaker economy? How did you read today's...
The hard place gets harder and the rock gets rockier. It's sort of how I'd put it. I think the bank made a choice today to really focus on downside risks to near-term growth, to really not want to take a stand on what the impacts of high oil prices are for the Canadian economy. Because the knee-jerk response is that high energy prices are good for Canadian growth in aggregate. Compositionally, there's a change because some sectors suffer, some sectors prosper. But conventional thinking around the Canadian economy is we are an energy-producing economy. High energy prices should be good for the Canadian economy. The Bank of Canada did not want to go down that road. They didn't go down it in the statement, and Governor Macklem really took great pains to avoid taking a stand one way or the other in the presser. So they were really putting emphasis on some of those near-term growth risks. And what's not clear to me, I think what's going to be the interesting thing to see, were they doing that to try and not embrace some of the very hawkish market pricing? Because markets are pricing in the Bank of Canada hike by the end of this year. I don't think that's going to happen. I don't think that's a real expectation people actually hold. I think it's more of a market technical issue. But the Bank of Canada may be wanting to push back on those market expectations a little bit. But it may be that they are just genuinely very concerned about the near-term path for growth. And in that environment, high inflation, which will come with high oil prices, that effectively prevents them from easing. Because the one thing, Governor Macklem, there's a little bit of, fool me once, fool me twice here. I think he would be very unhappy if inflation were to get out of hand twice on his watch. We can debate to what extent the Bank of Canada is culpable for the inflationary surge post-pandemic, but certainly they don't want to be seen as being caught napping on this one as well. So I think they want to be very careful to make sure everyone knows that they are watching the broader inflationary impacts, but at the same time, they don't want to embrace that near-term or relatively near-term hike pricing.
I noticed when the decision came out, I looked at the statement that came with it and then the opening remarks. It didn't take long for them to go from we're holding and we're concerned about the Middle East. So what can they actually, I mean, there's nothing they can do about it, but in terms of trying to form central bank policy around such a fluid situation, how do they manage that?
The governor actually said, I believe in the presser, that they can't do anything with monetary policy to fix the Middle East. I'm paraphrasing a little bit, but he actually did make that point. They have an inflation mandate. So for the Bank of Canada, the real trick here is to ensure that inflation expectations do not come out of control. So they're going to be looking at longer-term inflation expectations. Near-term inflation will move higher. There's nothing to be done about that. They can probably look through that shock, given that Canadian inflation had been brought back to target in recent months. Inflation was around 2% year over year, touch under, and the core inflation metrics had also been showing significant moderation in recent data points. So they are in a position where they are not going to be tempted to have a near-term reaction to the high energy prices. Inflation Canada is in a pretty good spot, even if price levels are pretty high. Because I'm sure there's listeners listening to me say that inflation's in a good spot, and they're looking at the grocery bills. They just fill up their car and they're like, what's he talking about? Exactly. Like, I get it. Right. But the Bank of Canada is not looking at price levels. They're looking at the rate of change in prices, and the rate of change in prices has slowed in aggregate. So they would probably see themselves in a position where they can really take their time to look through the energy impacts. They can really wait to see what that does to the Canadian economy without having to react very quickly, just because they do have a little bit of leeway in terms of having a starting point where they have hit their inflation target, whereas some other central banks that are still sort of grappling of trying to bring inflation under control, it becomes a little bit more challenging perhaps.
If it wasn't for the conflict in the Middle East, you just had an inflation report landed on Monday for Canada, 1.8%. Feels like a mission accomplished moment. Then you had that jobs report on Friday, which was very weak. Without this pressure on crude prices, the Canadian economy itself, how is it looking?
So the Canadian economy has had a bit of a tough few months, certainly. Like some of the recent data points point to slower growth in the first quarter than perhaps the bank had expected. They did make the point that the risks relative to their January forecast did tilt a little bit lower. We are still trying to disentangle a lot of different shocks here. The one the Bank of Canada focused on in their statement was around the trade disruptions of the United States, but we're also having to really see in real time how much of our past growth was driven by population growth. Senior Deputy Governor Rogers was talking about the housing market in today's press conference. It's hard for me to have a conversation of housing without having a conversation about population growth, because that's ultimately the thing that drives housing demand. So we're trying to disentangle quite a few shocks. The bank does seem to be looking at the economy as something that is maybe a little bit weaker than they would have hoped. And to take it to that employment point, they have a tool that works over 6 to 8 quarters. Not 6 to 7 quarters, 6 to 8 quarters. I always avoid 6 and 7 together now. It's something where if you look at the unemployment rate continuing to move higher, they would see that something that would cause future disinflationary pressures to build. And their goal isn't the lowest possible inflation rate. Their goal is a 2% inflation rate. So Canadian jobs data, and this is something like always needs to be said when we talk about employment data, it is so unreliable. It's so volatile that you never want to put too much weight on a single month's job print. Like it was only 3 or 4 months ago we were talking about multiple 80,000 plus job prints in a row, and things were apparently great, and now they're terrible in the jobs front. So I think that's an important piece of context, important piece of perspective to keep in mind. But if you were to have the labor market persistently weaken, that would be a sign to them that inflation was going to decelerate in 2027. And that would be a sign that they would need to perhaps lower interest rates to prevent that deceleration from inflation from taking place.
That's the central bank, and that's what we're facing right now. What about fiscal policy? And we had that big budget in the fall. Is it time now for the other side of the aisle to say, we got some challenges here, maybe we need to address them?
So I think the government is walking a little bit of a tightrope as well, just in terms of trying to boost the economy without trying to let spending sort of get out of control. And particularly as we're doing this in the context of rising interest rates now. It was very easy during the pandemic for governments just to throw more money on the pile. You know, the wheelbarrow can be a little bit higher, I guess, right? That was easy in the pandemic because it was a world where interest rates were very low. Markets were not responding to these sort of fiscal changes by changing borrowing conditions. They didn't need to worry about how much they were spending, essentially. That's not the world we live in today. One of the responses to this energy price disruption has been higher bond yields across the globe. We are in a world where markets are sensitive to supply and demand factors because we're not in a quantitative easing world anymore. So if you're the government of Canada, there may be a temptation to open the spigots a little bit more to offset some of these negative growth factors that you see in the near term, but you have an implementation issue. It's not the easiest thing in the world for a government to get money out the door quickly and in a way that is efficient. Now, rebates, tax cuts, these things can be done quickly. But if you want to talk about actual building capacity, going back to that age-old discussion that you and I have had so many times around the lack of productivity and spending money to address that, that can't be done in a scale of days or weeks or months. Those projects can take quarters to years. So while the federal government, I'm sure, will be watching closely, and if they see cracks forming in the economy, I'm sure they will be there with sort of targeted measures here and there. We had recently, there was a larger grocery rebate, I believe it was, sort of tied to the GST rebate. These things will remain possibilities in the background, but I don't get the sense that the government is going to seriously consider a needle-moving fiscal package. And I think if you are the government, it probably is worth waiting to see if the high energy prices actually do drive higher growth in Canada, and if they can be a catalyst for more investment in our energy sector, because that's something that we haven't seen, that sort of responsiveness from energy prices to investment. That really diminished the last decade or so, but I think this government would like to see it come back.